Yeah, I want to get on to some more updates on the silver. And, I'm going to tell you this, that, you might as well enjoy the ride because the way the things are going, it's like, before you know it, just like in 2010 when people were saying, oh, it's silver's too high, it's over 30, right? Remember that? Then 2011, early 2011, it started going over 40. And guess what happened? People were saying it was too low at 40. Of course, it was getting dangerous. So actually, you're pretty safe right now, even though it's not doing nothing. You're not making any money on the stuff. You're just sitting on it. But, you just in retrospect, you're probably going to be saying these are the good old days. It's going to be kind of scary when it goes up. But I'm going to give you a couple more facts on different things. One thing that's come up is that, I've been talking about the equities markets. People are actually, money is flying out of the equities markets. I don't want to display the chart. This is actually me riding a bike last year or something. I'll probably be doing some more videos of this stuff later. But people are not, people are pouring out of the equities. It's like the news chart, which I'm not going to display. It looks like a freaking cliff. I mean, where the money is actually outflows or money is flying out of the equities, yet they're not dropping. The equities aren't dropping. I think it's a precursor to, the whole thing's going to cave. It's going to cave all at once, and George Soros is going to win on the rest of his bet that he lost. Part of his bet he lost on, which was to, short the S&P. He lost out on part of it late 2014. But he'll lose out the rest of it if it doesn't happen sometime by late 2015. But, it's 16% of his net wealth, so it's not a hedge. I've been saying about that. Now, the other thing that came up is that the S&P's been going up, but there's no leverage in the market, which is weird. The S&P has recovered greatly since 2009, when it was actually at the early 2009 when it was at the low, right? The Dow and the S&P. But there's no leverage in the market. There's actually, we're at the lowest leverage, in other words, debt to equity, than we've been since 1988. That's unusual too, because usually when markets go up like that, it's because of speculation. The companies are actually flush with cash. They're paying off their debt. You know what's really holding up the markets? It's another indication. The Federal Reserve itself. And here's my point on that deal too. The Federal Reserve is going to, in other words, they're buying up, they're going out in the markets, and they're shoring these prices up. It's almost like if you went out in the real estate market, and the appraisers are going by the last 5 sales, and the last 5 sales of houses are to the Federal Reserve, and they're selling them, they're buying them at $250,000 each. Fine, whatever, So the appraiser's saying, yeah, the house is worth $250,000, but it's not. Because it wouldn't be if it wasn't for the Federal Reserve, acting as the market itself. That's exactly what's going on with the equities. So the other thing is, though, when you hold something on a balance sheet, it's at cost typically, not at market, right? Like, in other words, if you buy something for, $100,000 and it goes up in the market and it's $500,000, you still keep it on the balance sheet at $100,000. But say, for instance, it went down to $30,000 on the market, then you should actually make an adjustment to the balance sheet. That's actually the Federal Reserve balance sheet really is false. It's like what they're holding on their balance sheets, all this stuff they've been propping up in the marketplace by buying it up and keeping those prices high and actually shoring up the elite by doing so, it's going to be a problem when they go to unwind the balance sheet. In other words, unwind. How do they get the stuff off their balance sheet? Who are they going to sell this junk to? Who are they going to sell it to? Nobody, right? It's permanently on there. Actually, the Fed is leveraged 77-1. When the Fed goes down, you know what the bailout's going to be? The IMF. Yeah, because the IMF is 3-1. Now, here's something else I want to actually give you an interesting twist. We talk about the silver coins. I'm going to say this. I'm going to give you another tidbit here because, I'm actually in a financial area. I work in a CPA firm. Not every day, but, sometimes, I still do. But the thing is, a lot of people are saying we're going to a cashless society, and I know the big banks are trying to move us to a cashless society. I even put out, people didn't believe me, where they charged money to deposit. There was a bank fee to deposit cash. People said I was a liar, and I said no, because I've seen it. I've seen it. Not me personally that happened to, because I don't bank with those yo-yos. I think it was, I don't want to say the bank. I think it was Wells Fargo. But if you deposit so much cash in a month, they'll charge you money for that. They used to never do that. They're trying to get people away from it. But here's one reason they're not going to ever be able to really probably go to all electronic. And that reason is identity fraud, identity theft, identity fraud. The IRS, it cost the IRS $5 billion last year just due to identity fraud. $5 billion, not million, $5 billion. Because they had to pay out, to the legitimate people, and they paid out to somebody else. And what happens is when they have identity fraud, they have to give a 6-digit number on top of your SSN to the client, and they use that, and they use a new 6-digit number every year to do their tax return. So if somebody else uses that number, they know right away that, without the 6-digit number, they know that's somebody trying to scam and get the money, right? So, there's a lot of problems with identity fraud that, it almost leads to you like, even paper cash is going to look good to electronic stuff. But, here's another point I started thinking about is, even the physical coins we have that are not, that are like sandwiched with zinc and they have copper inside of them, and the actual commodity value in the coin itself is way below the numismatic value on the outside. In other words, minted quarters. The exception would be nickels. But if there's ever a financial problem where we have, the Federal Reserve needs to be bailed out by the IMF and we have these catastrophic problem here in the United States, I can tell you one thing, it probably wouldn't be a bad idea to actually keep a lot of physical change on your person. Actually, store a lot of physical change, because it's always going to be recognized as money. It'll be something somebody always will trust, and it's durable. And it's minted by the U.S. government, so it's always legal tender. I actually think physical, even though it's bulky, that's a problem. But, quarters aren't too bad, I guess, compared to a lot of other things. But, if there's actually hyperinflation, dollars are going to become, like the paper money, could very easily become destroyed in a lot of different ways, and could be, mangled up or whatever. Whereas even if you're not talking just physical coin, but actually just regular coinage that we have, if we ever go into a period of hyperinflation, that would not be a bad bet to have, because it is actually still legal tender. But when you have hyperinflation, what really happens though, it's hyperinflation only in food and energy, but pretty much everything else out there, the big hard durable goods, like things that people can stave off and not have to buy to survive, they go down in price a lot. Like, as a matter of fact, when we had stagflation in this country in the late 70s, if you went on the car dealership lots, in 1980, early 8, like, when the new 1980s were coming out, and the 79s were out there, they were heavily discounted by far. And a lot of people don't realize that, because even though oil went up a lot, they had so much oil, vast in price increase in oil, that they had an excise tax on oil. A lot of people don't realize that. That was the time of Mark Rich, when Mark Rich made all his money from trading in oil from Iran, which was illegal back then. But the thing is that the situation when you have a lot of hyperinflation, it's not hyperinflation across the board. There's hyperinflation in food, in energy, and absolute necessities. There is not there's actually massive deflation in large goods. So, you might be able to buy some things that, you might consider, maybe you'll be able to buy them like for pennies on a dollar, literally, with change practically. With change. It might be, lawn furniture. You think something like that. Would somebody really need lawn furniture? Maybe that wouldn't be something high on their list. Maybe it would be, appliances. But, if you're storing up hundreds of dollars worth of change, it might be one of the best things in the world, because I think that, in a long term, if there's a catastrophic problem, anything that's U.S. minted hard, durable coinage, even if it doesn't have silver in it, is still going to be a pretty good bet. I think it's going to be worth a lot more. Actually, the nickels, I think, would be number one. But I think anything else wouldn't be a bad idea, too. I mean, that's thinking outside the box. I don't know this for a fact, but, it's the fact that it's still durable money that's minted by the U.S. government. That might not be a bad way. And, you can't lose on it because it's always got the same face value. Now, the other thing is, I mentioned before a long time ago about Goldman Sachs probably having prior knowledge about the BP oil spill. You heard about that email that was leaked from the guy to his girlfriend. The girlfriend ratted him out about, they would make a lot of money on the oil spill. Well, Goldman Sachs back in late 2013, they talked about oil going up a lot. And, it went to less than half the price. When it went went to 40 or below 40 on a WTI, Goldman Sachs was talking $20 a barrel oil. Well, do you know when they were talking that $20 barrels of oil, they were the number one holder of double leverage oil on the way up. Them, along with Barclays and another bunch of other investment banks. Watch what those guys say, because, it doesn't take much to change the whole situation really fast. And there's boots on the ground right now in Yemen with Saudi Arabia. It's got boots on the ground in Yemen, and that is partly why the oil's been going up. You know why we really had a lot of oil price spikes, and they correlate when oil spikes up a real lot and it goes into a hard bull run. That's when you see gold, silver, platinum, and palladium and all the commodities go in a hard bull run, because usually that is a time of major conflict in the Middle East. So I think that with the situation that's coming up is that Iran is actually being strengthened by the Obama administration one way or the other. And, maybe that's the plan of the elite all along, that you're going to see a major conflict between the Sunnis and the Shiites, and you'll see oil go way the hell up. In the meantime, a lot of the shale oil industries in the United States are having a hard time. Some of them are being, going under. Some of them are being bought up by Wall Street for pennies on a dollar. But Wall Street, like I said, they've been betting double leverage oil. Not that you should, but I'm telling you, that's a good sign for silver and gold. So enjoy the ride, because when it goes up too high, you're going to be like, oh my God, it's too high. Should I sell? You won't sell at any price. That was the mistake everybody was telling me. What are you going to do? Take fiat? And I'm like, I don't know. It's like, I don't even want to argue with those kind of people. But that was the common consensus back then, when the silver was over $45. What are you going to do? Take fiat? The money's not worth anything. Yeah. The problem is, I don't know how high it's going to go, but I'm going to tell you, I think when the next time we really have a big blow up in the Middle East and it's serious, silver's going to go to 60 to 75. It's going to bust through 50, no problem, like it's butter, when it finally hits that top. But that's when everybody's going to be predicting $500. So enjoy the ride right now. And, don't worry about the shit too much, because, you're going to worry more. And you worry too much, and it's not good for your health, right? But the thing is, when it goes up, it's going to be more worrisome, because you're going to be afraid to sell. But there's a lot of indications that, it's been going on, like we've been having a lot of indications that things are going to be turning around, and they haven't been just yet. And there's been a lot of indications that the equities are going to really crash hard. And it's not just coming from the alternative media anymore. It's coming from the major media. It's about the leverage. It's about, net cash outflows. It's about the PE ratios. It's, the retail sector is getting clobbered. There's all kinds of stores closing down, Targets and all this kind of stuff. I mean, every Christmas time during, is actually getting weaker and weaker. So enjoy the ride, and that's basically it. Enjoy the ride while it's going.